Joining us today for our quarterly economic briefing following the Q4 QES survey. Got a lot to talk about this morning. One of the things is, of course, we've had the inflation figures released about an hour or so ago, and we'll get into that as we go through the presentation. And obviously, current restrictions going on with Omicron and COVID and one thing and another, and whether or not they're going to have any sort of significant impact going forward. We are recording this and we will be publishing it through various social channels. If you do have any questions as we go through, please pop them in the chat box. We'll have a chance at the end of the presentation for a Q&A, but if you've got anything that's as we go through, please just put them in the chat box. So without any further ado, what I'd like to do is introduce our head of research to take us through the results and give us his expert opinion on where things are at present and where they may go to in the future. Subrah, please, over to you.
Thank you very much, Chris. Good morning, everyone. I hope you're all well. Okay, so thank you for that introduction, Chris. That was actually very helpful. We've got a couple of important things for this morning. One is the QES presentation, the normal QES presentation. But one of the themes that we have been speaking about for quite some time is around skills challenges. You know, as we have seen in the QES surveys for the last couple of quarters, employment prospects are up, recruitment difficulties are a concern for businesses. And so what we have done is to partner with the Greater Manchester Learning Provider Network to create a Greater Manchester Business Employment Skills and Training Monitor. So I'm going to be presenting the results of the first phase of that survey and research work as well. So that's in addition to the QES. But first of all, the QES. So many of you will know what the QES is, but if there is anyone attending for the first time, the Quarterly Economic Survey is the UK's most reliable business survey. It's a very large private business survey. It has got a sample size of between 6,000 and 7,000 nationally. Here in GM, we get a response rate of between 350 to 450 every quarter. And we have been running this survey since the 1980s and have got that kind of a response rate, which means we have a very rich time series of data with various macroeconomic indicators. That sample size also means that the results are very reliable. And of course, it is important to bear in mind, these results are based on what you, our members, are telling us. What I'm doing, and as I've said this before, I'm just replaying your own views back to you with some additional commentary and additional information from elsewhere. The other interesting thing about the QES is that we are the first to launch in every quarter. So the results I'm presenting are for this quarter, the last quarter of 2021. And that gives us a little bit of an advantage because we are months ahead of official data. And because of all of those reasons, the QES is used by Treasury, Bank of England, the European Union, and many other organizations. And of course, if we are getting it right, these results should be useful for you because we are ahead of the curve. You know, this is the first city region level intelligence that you get, and that should be useful for business decision making as well. So what are we going to look into this morning? We'll cover the QES data and the Greater Manchester Best Monitor. The Greater Manchester Index, domestic and overseas demand, business investment confidence, some labor market information, and then the skills shortage issues. Now, the Greater Manchester Index is made up of 7 different QES measures, but it's one composite economic indicator. And the advantage of having one composite economic indicator is that you get a number that will give us an indication of where the Greater Manchester economy is at any one point in time. So it is a snapshot of the data for the current quarter, but it gives us one number that we can relate to easily. And as you can imagine, an increase in that number actually is good news because that shows that the economy is growing, but a decrease in that number is worrying. And during the heights of the COVID-19 pandemic, the Greater Manchester Index was actually in the negative. So it was below 0. And that gave us an understanding of the scale of the crisis that we have just come through. Okay, so the summary of the results. The Greater Manchester Index for this quarter is 32.5. That's a slight increase from the previous quarter. It's a 0.6 points increase. So I wouldn't necessarily say that it is a significant improvement, but overall, I think it indicates that there is some stabilization in the economy. Stabilization actually means that we have now started experiencing much lower rates of growth in percentage terms. And we have had these crazy numbers of, a 20% drop in GDP, and then an 11% increase in GDP, a 5% increase earlier in the year, and so on. But that has actually now given way to much smaller percentage growth numbers. So the Greater Manchester Index is at 32.5. But when we actually look into the component parts of the Greater Manchester Index, there is some varying performance. Domestic demand has actually decreased in this quarter relative to the previous quarter. That's true for manufacturing and services. There has been a slight uptick in construction output. And I think that's mainly in the last kind of 6 weeks or so. But what is really interesting is that international trade activity seems to have picked up. We'll look into that in some detail. But that is actually good news. Cash positions have, however, weakened slightly, and they have never recovered to the extent demand did. So that is a concern, that cash positions are actually weak. And of course, the field work for the survey was conducted before the Omicron restrictions were imposed. So in the case of hospitality, particularly, cash positions were already weak because of the difficulties that the sector has had. That is likely to be under further pressure now with the additional restrictions in place. But of course, the great news is that employment prospects still remain very good. And 95% of those businesses who responded to the survey and said that they had tried to recruit actually were recruiting for full-time permanent roles. Okay, that matches the other data that we have had access to as well. But this is the story of our times. Whenever the economy is doing well and employment prospects are up, recruitment difficulties also worsen. And that means the competition for skilled workers has gone up to an extent. From the employee's point of view, it is a seller's market because there is also a serious issue with wage inflation at the moment. Now, I mentioned that cash positions had weakened slightly. That has played into the business investment numbers as well. And so business investment prospects are still low. They're well below the pandemic levels. And that is a cause for concern because what we are experiencing still is consumer-driven growth. So let me just give you some context from the Q3 data. So this is the data for the months of July to September. The Greater Manchester Index in July was 31.9. July to September period was 31.9. That was an improvement from the second quarter. But growth was primarily driven by consumer demand. So that's us spending our money in retail, in hospitality, etc. The luxuries that we did not have access to in 2020. However, once consumer demand goes down, there will be a softening in the rates of growth, and that's what we anticipated would happen in this quarter. And to an extent, that's exactly what has happened in this quarter. That once consumer spending went down relative to the previous quarters, actually the growth rate has also softened. And so where are we now? And as I've said before, the Greater Manchester Index is at 32.5, which is a slight improvement from the previous quarter, but it's pretty much stable, not a significant improvement. Surprisingly, though, UK GDP grew by only 1.3% in the third quarter. That's well below forecast, because the forecast was GDP growth of between 2 and 2.5%. That did not materialize as such. So we have had the lower rates of growth already before the Omicron restrictions were in place. And that's, of course, the Q3 number. And we know that the GDP growth in the month of October was also below our forecast. And so that's what we are grappling with at the moment. In terms of this quarter, the fourth quarter, the forecast is that GDP will grow by 0.5%. It can't be much higher than that, we don't think, and that's because business investment is still weak, because there is this consumer spending issue. Consumer spending that generally tends to go up in the lead up to the festive season, but after the festive season, there will be a dip in consumer spending. But I think there is already a slight dip, especially in the case of some sectors, because of these restrictions that are in place. So that means there is not much room for a huge improvement in consumer spending at the moment. So we need business investment to pick up. And that's where the economy is lagging behind at the moment. And in fact, the national data shows that business investment is actually likely to decline in this year. That's relatively to 2020. Okay, so how are the sectors doing? Now, the services sector actually had a slight improvement between September and October, but manufacturing was down slightly. Construction output was also down by roughly 2%. So in terms of the sectoral picture that's playing into the national data, the GDP numbers, services was slightly up, just marginally. I think the index was 97.7 and then it was 97.9. So it's still below 100. That means there is a slight deficit when we compare pre-pandemic levels. But manufacturing and construction had actually gone down in the month of October. Okay. So let's get to Greater Manchester and look into the QES data for this quarter first. So first up, domestic demand. And I'm going to play the domestic demand slide in two ways, the sectoral picture and then the regional picture, because it's also interesting to understand what's happening in different parts of Greater Manchester. So from a sectoral lens, we have had a dip in manufacturing and services, and this is what I was, domestic demand is was fueling UK growth. We have had a slight decline in this quarter, but I must tell you this: those numbers are still in the mid-20s. So please pay attention to these numbers here. And what we had during the crisis, so in 2020 and even in the first quarter of 2021, those numbers were well below zero. So they were negative. They are very much in positive territory at the moment. But what we think is that the levels are closer to where they were in the second quarter rather than the third quarter. So there has been a slight quarterly dip, but those numbers are still looking very healthy because they are in the mid-20s. Construction output actually seems to have picked up slightly in November. And again, that's good news. Construction is actually a very visible sector at the moment in GM. We look at all of the activity that is taking place in the key hotspots for construction activity. And it is likely that there is a further pipeline of work, but that's the critical thing for the construction sector. There needs to be a further pipeline of work for there to be more expansion within that sector. So that's on domestic sales in the quarter. What about advanced orders? The picture is very similar. Manufacturing and services down, construction activity slightly up, even in terms of the advanced orders. So that must indicate that there is something happening in terms of the pipeline. What is concerning here is that the manufacturing number has now come down to 10. So in terms of advanced orders, and again, this might be the post-festive season dip, but there is that slight dip even in services. So it may be that we are actually starting to see that softening in growth already, and it is because of these restrictions, plus the fact that we'll be entering the post-festive season in January. There is likely to be a further softening in the GDP growth numbers. So advanced orders down for manufacturing and services, but slightly up for construction. So that's on domestic demand, sales to UK-based customers. So what is the situation if we look at this from a regional lens? And what we do is to split the data by the three key regions in GM. GM North consisting of Wigan, Bolton, Bury, Oldham, Rochdale. South would be Salford, Trafford, Stockport, Tameside, and then Manchester City is Greater Manchester Central. Now, there is one trend which is common for all three sectors, which is that there has been a dip in this quarter. And that's true for all the three regions. Greater Manchester South has been underperforming for quite some time now. That trend started in towards the end of the last year and has continued into this year. A bit surprising. Obviously, when consumer spending was the key driver of growth, we had huge amounts of activity taking place in Manchester, the hotspot for retail and hospitality. There has been a subsequent dip. Greater Manchester North has also had a slight dip in this quarter. In terms of advance orders from UK-based customers, again, the regional picture is very similar. There has been a dip in all three regions. So these restrictions will probably likely worsen that slightly into the first quarter of 2022. So that's the domestic demand picture, where we have actually had a decline. In contrast, however, we have had an improvement reported in international demand. So that's export sales and export orders. Now, I must caveat these numbers. The one thing that we have seen, and that's a trend which we have had for nearly 2 to 2.5 years, is a huge amount of volatility in this export demand data in the QES. Initially, we had all of the uncertainty associated with Brexit. We had a significant increase in international trade activity, which was down to stock taking, businesses trying to push shipments before the Brexit deadline. That actually caused an increase. There was then a dip towards the end of last year. And then, and since then, the numbers have started recovering. Okay. Why there has been this massive jump in services, I honestly do not know. What we can't match this up is with other data that we have access to, primarily the export docs data that is processed by colleagues in the international trade team. Those numbers, the number of export documents processed, still remain lower than where they were in 2019. But there is another trend that has happened, and that's down to shipping costs. I think I mentioned this before. For a 40-foot container in the pre-pandemic time, the cost was roughly $13.50. For a 40-foot container now costs 12,000 plus pounds, apparently. And that's information that was given to us by our members in that sector. Now, that obviously means businesses are trying to combine shipments into smaller number of shipments. Various things are being combined, but the value is still high. So where we've actually had a little bit of a spread, what I think is happening is there are delays in the supply chain. There are shipping cost concerns, and as a result, it is likely that businesses are waiting for shipments to be grouped and then shipped out, which means the value might be actually improving, but the number of shipments is still down. But we will need to keep a very close eye on those export and international trade numbers. We know two things. One is that international trade activity has actually had a significant improvement compared to 2020, but they are still somewhat below where they were in 2019. So those two facts are there. We have got other data to match that up with. Why there has been a sudden quarterly improvement in services particularly is actually quite surprising. The manufacturing data, actually, again, there has been an improvement. That's true for some other parts of the UK as well. So this is good news in the sense that international trade activity has picked up and to an extent has made up for that decline in domestic demand. Okay, so on to the other QES measures, cash flow and capacity utilization. Cash flow remains a concern. It was the key concern for businesses when the pandemic struck. So in Q2, Q3, etc. of 2020, those numbers were again in negative territory. We have had a significant improvement since then, but the problem is cash flow positions are nowhere near the demand numbers. And that means two things. One, the ability of businesses to further invest in capital projects is muted. We'll get to investment later. So that's one concern. And the second concern is, with these restrictions in place, how sustainable is it to keep businesses shut or operating at lower levels of activity without the government actually providing additional support? And that is a conversation that we have had with civil servants. Our view is very clear. If there is going to be disruption and if businesses have to either trade lower volumes or have to be closed down, there must be matching support for that activity, because cash flow is a big concern. And of course, we have the other pressures that we have talked about before. Tax liability, which was deferred, has to be repaid. The debt that was taken on during COVID has to be repaid. So cash flow will come under sustained pressure as those things start to have an impact as well. The other important macroeconomic indicator is capacity utilization. So, what percentage of capacity are businesses operating at? There has been a decline in construction activity. That's a marked decline compared to the second quarter, dip in the third quarter, and then a further dip in the fourth quarter. Services has actually improved, so that's now looking at 50% plus. Manufacturing has had a slight decline, that's now below 50%. We want these numbers roughly where construction was in the first and the second quarters. We want them to be in the 70–80% mark. And that's really, once more and more businesses are operating at higher levels of capacity, that's when we will see the business investment data actually turn positive. So at the moment, capacity utilization is not where it was before. We need to see those numbers improve, but that's dependent on the cash flow positions. It's also dependent on certainty in the public health scenario, because one of the things that's playing up with business investment and all of those other measures is the uncertainty and the volatility that we are still seeing with the public health scenario. Okay, so what does that all mean for business confidence? And this is, again, indicative of further stability. So between the third quarter and the fourth quarter, the current quarter, there hasn't been a significant change. So in the third quarter, 57% of businesses said they are actually very optimistic. Roughly 10.5% said they are not very optimistic. And those numbers have not shifted in any meaningful sense. So 11% saying they're not at all optimistic, and 52.5%, or 4.5% percentage points a drop in the proportion of businesses who are actually optimistic that they can maintain their turnover. But what about margins? And this was a concern. Margins have been under pressure. Margins will continue to be under pressure because of inflation. But again, there has been a drop, sort of an 8 percentage points a drop in the proportion of businesses who are actually optimistic that they can maintain their profitability and margins going forward. And there has been a 5 percentage points increase. So roughly a fifth of the businesses are now saying that they are seriously concerned about their ability to maintain margins. That's all down to price pressures and other issues that are taking place. So business confidence is not very high at the moment. Again, we need to see these numbers improve. They've been relatively stable in the last 6 months. That is a positive. So there has been a significant dip, but again, to point out, the field work was conducted before the restrictions actually were imposed. So there is likely to have been a further dip in business confidence, especially in those worst affected sectors after the restrictions came into effect. So that's on business confidence. And what do the low levels of business confidence mean for business investment? And we have broken it down into two. So the capital investment in machinery and equipment, and then the investment in training. Now, investment in machinery actually is directly proportional to capacity utilization. Where we have high levels of capacity utilization and more demand coming into businesses, that's when there will be an expansion in investment on new productive facilities. That's not necessarily the case at the moment. That drop in construction is quite stark, from a balance of 40 down to below 10. That's actually a bit of a surprise, but it could be because construction sector businesses were starting to an extent, starting to think like manufacturing businesses, and trying to stock up on essential materials because of the supply chain disruption, the high cost of materials, and also the significant delays in the delivery of materials. When we speak to construction businesses, that's the #1 concern for them now. Previously they were grappling with skills challenges that has not necessarily gone away, but now an even bigger concern is the availability and of raw materials and the time that it takes for raw materials to actually be delivered on site. So even construction businesses are trying to stock up on essentials. And of course, that's not necessarily possible in the case of construction, as it might be in the case of other sectors, but that is something that has happened in the recent past. So when it comes to manufacturing, fairly stable. Services has had a slight dip, but overall, the prospects for business investment are okay. They have been stable for pretty much the last 6 months, but there is some concern here that unless these numbers pick up, we are not going to see a significant improvement in the economy, because that consumer-driven growth will likely give hope at some point in time. Okay, what about investment in training? And this is the odd thing. During downtime, when there are concerns, when there are pressures on business cash flow, the number one item that is often cut in business spending is investment in training. But of course, when the economy booms and businesses started recovering, that's when training is absolutely critical. But this harsh reality is that investment in training is also dependent on how businesses are faring at any given point in time. At the moment, the investment in training numbers aren't that great, so the balances are just touching 20, below 10 for just below 10 for services and manufacturing. There's just touching 20 or so for construction. So that's where the investment in training numbers are. And of course, we will look into skills challenges and training a bit more in detail when I get to GM Best. So that's business investment. And what about inflation? The sort of the elephant in the room. Now, there were inflation numbers announced this morning, so I have to revise my data just slightly, but let's look into the QES picture first. Now, the QES question that we have on price pressures and inflation is, what aspects of price pressures are of most concern to businesses? And across the board, price pressures are now a significant issue. Pay settlements are up, and that's because businesses have been forced to increase wages because of the skills shortages. I spoke about raw material prices. Raw material prices are up. There are also delays in raw material prices, which means you've got cash that is stuck in inventory. Finance costs have had a slight increase, and then overheads are going up. And the number one concern, obviously, is inflation. That's well above 45 now. So what does that mean? If input prices have gone up, if the cost of operations are going up, that invariably means we have to increase the price at which we sell our goods and services. And again, that you get into that vicious cycle where you have high price pressures, the cost of operations go up, prices go up, and then that in turn leads to inflation. But inflation was also sustained by the huge levels of demand that we experienced in the last 6 months, and of course, energy prices. And energy prices are at record high at the moment. And the price cap is not necessarily working at the moment, and the price cap, it's going to go up. That threshold is going to go up in April. So if energy prices continue to keep going up, then we're going to see further inflationary pressures emerging. So prices have gone up. Now, the 12-month CPI was 4.2 in October, but it was 5.1 in November. That's the data that was released earlier this morning. Chris referred to it in his opening remarks. It's 5.1% now. So that would be a 0.9% increase compared to the previous month. So 0.9 percentage points increase compared to the previous month. Inflation of above 5% is a big concern, and the target for the Bank of England is 2%, as you would know. And in fact, the IMF yesterday has asked the Bank of England to increase interest rates. That's not necessarily obligatory on the Bank of England to do so. And again, the other concern for the bank might be that we are actually having restrictions imposed. The public health situation is not very certain. So there may be some concern about increasing the interest rate at this moment in time. But at the moment, inflationary pressures are a serious concern, and more than 50% of businesses are saying that they might have to increase the price at which they sell their goods and services. Okay, and then finally, on to the labor market data. So we know that there is a significant improvement in employment prospects, and that has been the case since we started recovering from COVID. Now, there seems to have been a slight quarterly dip in the proportion of businesses who are attempting to recruit. Don't be concerned about that, because if we look into the numbers in detail, well, for manufacturing, it was about 70% in the last quarter. It's now somewhere in the mid-60s. Likewise, in construction, it was just above 70% in the last quarter. It's just about 60. So 60% of construction businesses, about 65% of construction of some manufacturing businesses, and just about half of service sector businesses are all trying to recruit at the moment. And we had the labor market data, which was released by the Office for National Statistics yesterday, and that confirmed this, that actually there has been a slight decline, but unemployment is down. We have had a record number of vacancies in the economy, and all of that means recruitment and difficulties are up now. Now, this is where recruitment difficulties are at the moment. So the manufacturing sector, more than 80% of businesses are saying that they are facing recruitment difficulties. When it comes to when it comes to construction, it's more than 80. Manufacturing also about 80. Services about 60. So, across the board, there are a huge number of vacancies. That's true for all sectors. It's true for all regions. We have had significant recruitment difficulties in the economy at the moment. There is a shortage for talent, and there are wage inflationary pressures as a consequence of recruitment difficulties. Now, we have been speaking about this for some time, and so we decided to actually do something about it. We decided to understand why businesses are facing recruitment difficulties, why you're facing recruitment difficulties, and what could be done as a response to that. And that's where the partnership with the Greater Manchester Learning Provider Network comes in. So we came together for the Greater Manchester Business Employment Skills and Training Monitor survey. Now, the context, of course, is that the labor market is in flux. So on the one hand, you have a record number of vacancies and recruitment difficulties, but we also know that the consequence of the pandemic, the impact on hospitality, the impact on retail, etc., has actually had an impact on the employment prospects of several people, particularly young people. And so there seems to be a mismatch between what employers are demanding now in the post-COVID world as against what those young people might probably have in terms of skills. So that means that we have a significant upskilling and reskilling challenge in our hands. And COVID has brought about structural changes in the economy. There are also changes to the way we work. Remote working has become a lot more common, but that requires young people to have a separate set of skills, particularly soft skills. And so that's one concern that businesses are mentioning. And so we came together to develop comprehensive skills intelligence that is based on a real-time data that you, businesses, the business leaders, business managers can actually provide us. So when we are talking of recruitment difficulties and the causes for recruitment difficulties, the types of training that might help alleviate some immediate concerns, it's based on what you have told us. Okay, so it is rich, it is accurate because it is you telling us that, and it is also real time. Now, the results that I'm going to present in a moment are based on more than 1,000 responses. So we have had additional GM Best questions in the third quarter's QES. We ran an independent survey in September, October, and then we have had the additional GM Best questions in the latest QES as well. So that has given us more than 1,000 responses. So this is probably the best skills intelligence that we have for Greater Manchester. Because what we are able to do with that type of sample size is that it is granular. The information goes down to local authority level, and it can capture the differences between the different local authority regions in Greater Manchester. Now, in GM, we already have the institutions and the mechanisms in place. We have a devolved skills budget, so Greater Manchester Combined Authority is doing a good job of actually skills planning and provision, managing that. But that's done at the GM level. And that's good because we have the institutions in place to be able to do that. But the assessment of skills needs must take place at the local authority level. And that's because there are significant differences between what's happening in Bolton versus what's happening in Stockport versus what's happening in Manchester. And that's where the GM Best actually provides that real-time, granular, local, place-based skills intelligence. And it is a really good data set. It will be extremely useful. And what we have done is, instead of actually just doing some slides on it, we have converted it into an interactive dashboard that's web-based. everyone has access to it. You'll all have access to it. It's on the Chamber website. It's also on the Learning Provider Network's website. And I can just showcase some elements from the dashboard, but because it's on the website, you can all go and have a look at it. So let me just get into a couple of things now, just to highlight how stark some of those regional differences are. So I spoke about recruitment difficulties, but where are those recruitment difficulties? What types of roles are businesses are you facing challenges with? And of course, the situation is very different. So let's just look into Wigan for a moment. Now, in Wigan, for the technical and skilled roles, there seems to be a huge amount of demand. So nearly 2/3 of businesses in Wigan, actually it's 70%, closer to 70%, are reporting difficulties recruiting for technical and skilled trades. But when it comes to professional and managerial, that number is significantly lower in Wigan, and likewise for unskilled and semi-skilled. But let's just compare that with, say, what's happening in Bolton, for example.
So we've not got the slides on screen.
Oh, I'm so sorry. I'm so sorry. Let me I might have to stop sharing and then pull that back up. Just bear with me a second. So sorry. That's probably because I navigated to the website. Okay, can you see that?
Yeah.
Okay. Okay, no problem. So the dashboard is on our website. It's also on the website of the Learning Provider Network. And I just want to show you a couple of things, as I was just saying. It's an interactive dashboard, so you can go and focus on a local authority if you wish. You can also select, a couple of local authorities for comparison. So I was just talking about Wigan. So as you can see, the green line is Wigan at the moment. 70% of the businesses are actually struggling to recruit for technical and skilled roles. But when it comes to professional and managerial roles, that proportion in Wigan is just about 30%, under a third. But look at Bolton for comparison. In Bolton, less than 40% of the businesses are trying to recruit for technical and skilled roles, a slightly higher proportion compared to Wigan for professional and managerial roles. But then, when we look into some other local authorities, again, you get a slightly different picture. So in Manchester, nearly 45% of businesses are recruiting for professional and managerial. The point I'm trying to make is there are significant variations between different parts of local GM. We need to take into account the business demography in a particular region. And we also need to take into account the types of occupations, the types of skills that are needed in those different regions. Let me just point out one more issue, and that's on the training that's needed in different parts. That's obviously a very noisy and crowded chart. But again, start with one local authority. One of the things that will be of particular interest to learning providers would be to understand where the employer demand is. And of course, businesses can tell us where training or what type of training will actually be useful to tide over the immediate recruitment concerns, but also the upskilling and the reskilling challenge. And so we decided to understand that scenario. Anecdotally, we have heard that there is a huge amount of demand for, let's say, digital marketing because of the pivot to digital phenomenon that we saw over the last 12 to 15 months. That actually, the basic business skills, the basic IT skills, etc., are of concern. And so businesses are looking for training on that. Now, that's to an extent true. So in Bolton, for example, the basic functional skills, nearly a third of businesses are looking for training in that area. But again, the picture actually changes. So if we look into some other area, for example, in Rochdale, you see the soft skills issue is coming up in some parts of GM. And so we have had the situation where, teaching and learning has been remote for some time. Young people need a different set of skills to actually be able to manage work remotely, but also, into the workplace. So we have seen a deficit in terms of soft skills. That's a concern that has been pointed out to us by you. And so, all of this skills intelligence has been brought together in one place. It's probably the best local level skills intelligence that is available at the moment for GM. Now, this is not the end. This is the first phase. There is going to be a second phase between Jan and March, so we'll seek to engage with you even more on that. And of course, we're going to follow up this dashboard with another one, which actually breaks the data down by sectors. And again, we can now break the data down by individual sectors rather than just the sector groups of services, manufacturing and construction, because we have got the sample size to be able to do that. So all of you who have contributed to the QES and the GM Best, sincere thanks. This level of intelligence and the information that I have all presented is possible only because you have given us your responses through the surveys. That's the dashboard, and that's my presentation. If you have any questions, I will try to answer them, but I'm going to hand over back to Chris at the moment.
Okay, thank you so much, Subrah, for that. And again, some really interesting things happening there. And again, the caveat, I suppose, around all this is that the survey took place, I think, before any of us had even known there was a Greek letter called Omicron. Never mind what the impacts of the restrictions were. So it'll be interesting to see what happens going forward into Q1. Has anybody got any questions? I've got a few lined up about some of the things we've talked about this morning. If anybody has got anything, just put it in the chat box. And obviously, from Greater Manchester Learning Provider Network perspective, it'd be great to hear from you on the back of that.
Well, thanks, Chris. Subrah's done a wonderful job explaining the concept, the joint concept that we've worked together on and will continue to work together on. So I won't revisit that, but there will be people online who haven't a clue what GMLPN is, and it trips off the tongue, but it's the Greater Manchester Learning Provider Network, and our network actually has 100 members. It includes all the colleges across GM, universities, but also about 70 independent training providers. Local authorities are also delivering, as our volunteering community. So what I'm trying to describe is there's a whole range of different kinds of vocational skills providers across GM. And between them, they deliver about 70% of all the apprenticeships in GM. So there's a real force out there to deliver the skills training that this data demonstrates is required. Additionally, there's a considerable amount of funding in admittedly complicated streams of funding across GM, but there is funding available, and that's available for upskilling employers' existing workforce, as well as recruiting new skilled people. So we want this dashboard and this concept to really have an impact on bringing employer needs and training providers supply together. And we intend to pursue that goal in the next quarter and beyond to make sure that we can facilitate that joining up, because there is a dissonance, obviously. And we get that, when times are difficult, skills investment goes on the back burner, but there is funding for skills investment available. So we want to make that really out there. And if you've got any suggestions, as Subrah says, as businesses, as employers, or even as providers, to really enhance this concept, we are really ready to listen. Thanks a lot.
Okay, thanks very much, Anne. And it's such an important issue. This, Subrah said, we've talked about these sort of things for some time now. We want to start to try and move it forward and bring forward some form of action in that. There's a quick question from Joseph that I think Subrah may have just answered. Just trying to keep up to date with the chat about the numbers of responses. And it's a little bit sometimes like the general overall QES response. We tend to get more from where we've got more members. That generally tends to be sort of Manchester and whatever, but there's about 60, 70 from each borough. One of the things we are looking at doing is obviously expanding this to a lot more businesses, so we can really get down and get that granular detail in a lot better fashion, really, to begin to do something with this. Paul Winterbottom has sort of hit a question here, and I was going to ask about this as well, over the increase in interest rates and the economic impact on that, and whether you've done any modelling to understand what that means. And a sort of subsequent one that I wanted to ask as well, Subrah, was surely the Bank of England's not going to sit on its hands again. Surely we're going to see some interest rate rises in the not too distant future, which I think Paul's hinting at there as well.
Yes, I think when we did the QES presentation last quarter, we were looking at inflation of 3% or more. An increase in interest rates is only a matter of time. It has to happen, and I think it will happen very soon. The concern, of course, is what is going to be the impact of the Omicron variant, and how restrictive must the restrictions be. We haven't done any modeling, but we know a couple of things. Number one, at the moment, financing costs are not very, very high. So the concern around financing costs is not as high as, let's say, the price of raw materials or wage inflation. But there is debt that is due to be repaid, and so if interest rates go up, we're going to see two things. One, consumer spending will be under pressure because that contributes a huge amount, 300 billion on average, every month to the sustaining economic spend. That is obviously likely to come under pressure. It's very difficult to put a handle on it. But the second thing that it is likely to have an impact on is there is going to be even more pressure on cash flow positions, and that's likely to have an impact on business investment. And I think the business investment figures are already under a significant amount of pressure at the moment. So I think if interest rates do go up, we are likely to see some moderation, further moderation in the rates of growth that we experience. And what I'm really curious to understand is what impact it might have on the recruitment numbers and the recruitment difficulties, and even the investment in training situation. So that's not an accurate answer, Paul, but that's the best answer I can give you at this moment.
I think it's important. I think it's something in there that's going to sort of. There's all sorts of things, isn't there, at any one time lurking around with regard to the economic context, and I think this is one that. Well, to be quite honest, I think I can remember the time when the monthly announcement from the MPC and what the interest rate was actually, generated some interest, if you pardon the pun, in a lot of people. It's been at such a low rate now for such a long time. I think people have forgotten about it. So, if it starts to escalate from there, that could begin to cause a few people some extra shocks or whatever to the system. So we'll just see, and we'll obviously keep our eye on that. That's going to be a major one. So I'm just picking up as well on the point you just made there around the loan repayments as well, because again, we're moving into that phase, aren't we, whereby at present we've not got any hint or anything from government about any possible support for business. That could probably take up a whole different event to talk about that one, but at the moment in time, we're in a position where restrictions are having an impact, certainly in hospitality, impacting on cash flow. And also we've got those loan repayments looming, haven't we? We've said this for some time now about what happens when that starts. At the time, it was probably modelled on the fact that we'd be out of things by now and things would be thereabouts back to normal. Can you see government changing anything around when those repayments start, or changing the rules yet again? Do you think they're just going to hang fire, as they seem to do about a lot of things these days, and wait to see what goes on and then make some snap decision later on?
Well, that seems to be the general trend, that there are snap decisions taken, and even the announcement of the restrictions, came at the really last moment, and They're going to take effect soon after that. From a macroeconomic point of view, I think the concern that many people might have is, at the moment, the support for businesses is all monetary, because what the government can do in terms of fiscal support for businesses at this time, I think the indication has been that, well, there is no need to provide any additional support to businesses at this stage. We in the lead up to the autumn spending review and the budget, we heard in the news that there was apparently a lot of debate between number 10 and number 11 about giving support versus not giving support and fiscal prudence and that sort of thing. So I think at the moment there are no indications that there will be any additional support that is available. Having said that, the government has changed track. So, for example, the VAT on hospitality, the 5% cut, that was obviously extended until March. Will it be extended again? We do not know. But again, if that VAT rate goes up to 20% in April, we're going to see further pressure on inflation, of course. Yeah. But there does not seem to be any indication of support that might be made available. But the position should be very clear. If businesses are forced to restrict the volume of trade or shut down temporarily, then there must be support that's made available. That's because employment will be affected as a consequence.
Again, another one we've got to keep our eyes on, and this is why I suppose this is the real beauty of things like the QES, that we're not just sort of assessing things and coming up with judgments in our own mind. We're basing these on what businesses have told us, which is absolutely crucial at times like this, that we hear directly from the front line, as it were, in what's going on. Sharon and Alan have had a quick exchange about training for soft skills for younger people, and put a little bit of information on there, as well as her email address in the chat box. If there's any more information you want to know about what availability is around that, please get in touch with Anne. And again, there was a exchange just at the start of the presentation. Richard Weston was asking around, the question: investment in training is declining when skill shortages are greater than ever. And again, some responses there from Anne around confidence and matching demand and supply. Joseph Crowlers said, people are already short on staff, so again, it's availability of releasing staff time to do training, which you can quite understand. And then there's there's the old chestnut there of when pressures are on with cash and things are taking a bit of a downturn, a lot of businesses do look for the first things to cut. For example, marketing, training, other things like that, which just seem to be not directly involved on the day-to-day running of the business, but as I put in there, it's sometimes a bit of a false economy to look at things like that. Subrah, from your point of view, are you surprised at where those numbers are around, investment on training and some of those job figures as well? Because we use phrases, don't we, like there's some odd numbers and it looks a little bit different, and it's there's a huge gap here and a bigger gap here and one thing and another. These really are sort of unprecedented, aren't they? I've been trying to work out the last time the labour market really looked as sort of odd as this, really. I mean, it's going to take some time to sort out, isn't it?
Absolutely. And the point that you and Joe made about the availability of time, that's highlighted as the #1 internal organizational barrier to actually the provision of training. Cost is a separate issue, but we captured those under separate headings. But being able to release employee time to do training puts pressure on a scenario when we already have staff shortages. Am I really surprised by those numbers? I'm actually surprised by some of the findings. Yes, I'm surprised by two things. One is to understand the thinking. The debate on skills is sometimes a bit confused, because we keep talking of, well, there is a labor shortage or there is a skill shortage. But the realization from GM Best is that there are actually a whole host of other issues which actually impact training, the provision of it, but how do you access it? How do you fund it? and of course the demands which are local. At a business level. So if we are sending employees away to training, then to an extent the geography does not matter, because it is very relatively easy for someone who is based in Bolton or in Wigan, etc., to get to Manchester for a couple of days of training or a boot camp or anything. But actually, when we look at FE, the provision of training at levels 2, 3, 4, etc., then the geography actually is a significant barrier, because we know that up to level 3, the absolute majority of young people actually prefer to have courses in their own local authority. And so if we are actually going to enable the best training that is needed in a local authority to meet employer demand, then that must match what businesses are required in those areas. So that realization that there can actually be very stark differences from one area to the, but also sector. I haven't really put up the sector picture yet, and that's because the data is still being analyzed. But the interim results that I presented at a couple of occasions, wholesale and retail, for example, what was the number 1 skill that they were looking for? It was around soft skills, and the number 2 was customer service. Now you would say that's not surprising. Which is true. That is not surprising that actually retail businesses and hospitality businesses are looking for customer service training or for soft skills, because they have to interact with our customers on a daily basis. But when we look at the provision of skills at a macro level, you wouldn't really think about customer service as an important area of training that should be offered to hundreds of or thousands of young people. And so that discovery was also actually quite a pleasant surprise.
Okay, thanks, Subrah. There's one last question in the chat box there. Richard Weston again. I think this may be aimed at Tom Stannard, I think, who's logged on today from the Chief Executive of Salford, about looking at the best data. There seems to be a wide variation in numbers by borough. For example, Salford only has a 3% need for logistics skills compared with 27% for nearby Trafford. Any views, Tom? I don't know if Tom wants to come on and answer that question. If not, I think that's a great example, though, of where there is a difference. Sometimes we look at things just from a GM level, and you then get the sort of aggregate, the average of what those demands are. It's only when you actually break it down within those areas you begin to highlight where it's actually needed. I mean, obviously 27% for nearby Trafford, I guess that is driven by Trafford Park and some of that. And again, the idea behind the data and the great benefit of that is we can begin to tease some of that out. Just one comment there from Hannah in our Skills for Growth team about that as well, about the fantastic opportunity there for training. So we'll try to a halt there. It is 10 o'clock. And like I said, I know people have got all sorts of things to be getting on with in the countdown to Christmas and that extremely busy time of year. Subrah, I'd like to thank you once again for your expertise, overview, and the calm way you've done it. We were a bit worried when he logged on this morning that he was actually stood outside on Deansgate. So I told him to wrap up and put a scarf on before I realised it was obviously a background. Anyway, apart from that, thank you, Subrah. Thank you as well, all for joining us. This is the last, I think, GMCC event that we're running solely on our own this year. So it's been great to have you all through 2021 for joining us, and looking forward to 2022. And the last thing to say is obviously, it's very tricky, isn't it, at present? And as I said to some of the team on an earlier call, we've faced a lot worse, haven't we, over the last year and a bit, and one thing and another. And it is sometimes easy just to slip into a bit of here we go again despondency. It's up to us all not to do that. Things are tough. It's not easy by any stretch of the imagination, but also there's a lot of good stuff going on out there, a lot of opportunities. We're nowhere near where we were this time 12 months ago. And as we've seen from that data, if you really want to have a look at where we were 12 months ago, just have a look at Q4 2020 and look what's happened since then. We are on the way out of it. You're going to get these anomalies. You're going to get these odd spikes in things, one thing and another, but the general direction is going in the right way. I think to get, sort of 2 or 3 quarters of 30 odd points on the GM index is something we should be all quite proud of, and what we do in our work and in our businesses here in Greater Manchester. So it remains for me to say is wish you all the very best for Christmas and the new year. Look forward to seeing you all again in the not too distant future, and please stay safe, but enjoy yourself as well and carry on doing what you are doing. Thank you very much.
Bye. Bye-bye.